Top 25 KYC Analyst Interview Questions and Answers. Welcome to Interview Q&A. If you're preparing for a KYC Analyst interview, this video is your complete guide. Whether you're a fresher entering the compliance world or an experienced professional aiming to move up, these top 25 KYC Analyst interview questions and sample answers will help you sound confident and job ready. We'll cover everything from regulatory frameworks and client onboarding to AML red flags and risk assessments. So, grab a notebook and stay tuned till the end. Let's begin. 1. What is KYC and why is it important? KYC stands for Know Your Customer. It's a critical process financial institutions use to verify the identity of clients, understand their financial activities, and assess potential risks of money laundering or terrorism financing. The main goal is to prevent illegal activities and ensure compliance with AML, anti-money laundering, laws. KYC helps protect both customers and institutions by promoting transparency and accountability. Without proper KYC procedures, banks could face severe penalties, reputational damage, and even legal consequences for failing to detect suspicious activities. 2. What are the key components of the KYC process? The KYC process consists of three main components: Customer Identification Program, CIP, Customer Due Diligence, CDD, and ongoing monitoring. CIP involves verifying customer identity through documents like passports, ID cards, or utility bills. CDD assesses the customer's risk profile by analyzing their source of funds, business activities, and transaction behavior. Ongoing monitoring tracks transactions continuously to detect unusual patterns or red flags. Together, these ensure compliance with AML laws, prevent financial crimes, and maintain institutional integrity. 3. What's the difference between CDD and EDD? Customer Due Diligence, CDD, is a standard process applied to all customers to verify their identity and assess risk levels. Enhanced Due Diligence, EDD, on the other hand, is applied to high-risk customers, such as politically exposed persons, PEPs, or those from high-risk jurisdictions. EDD requires deeper investigation, reviewing the source of wealth, transaction patterns, and ownership structures. The main objective is to ensure that the institution fully understands the nature of the client's activities and potential exposure to money laundering risks. 4. What is AML and how is it related to KYC? AML stands for Anti-Money Laundering, a set of regulations and procedures designed to prevent criminals from disguising illegally obtained funds as legitimate income. KYC is a key component of AML because it ensures financial institutions know their clients, understand their financial behaviors, and can identify suspicious activities. Without KYC, AML frameworks would fail to detect illicit transactions early. Essentially, KYC is the preventive step, while AML represents the broader system of controls, monitoring, and reporting. 5. What documents are typically required for KYC verification? KYC verification usually requires proof of identity and proof of address. Common identity documents include passports, national ID cards, or driver's licenses. For address verification, banks may request utility bills, tenancy agreements, or bank statements not older than 3 months. For businesses, additional documents like incorporation certificates, ownership structure charts, and tax identification numbers may be needed. These documents help confirm authenticity, detect false identities, and meet both local and international compliance standards. 6. How do you perform risk assessment in KYC? Risk assessment involves evaluating how likely a customer is to engage in illegal activities such as money laundering or terrorist financing. Analysts use several factors: geographic location, customer type, business activity, transaction volume, and political exposure. Each customer is then classified as low, medium, or high risk. High-risk clients undergo enhanced due diligence, EDD, and more frequent monitoring. The process ensures resources are focused on higher threats, improving efficiency and regulatory compliance. 7. What are politically exposed persons, PEPs? PEPs are individuals who hold or have held prominent public positions, such as government officials, judges, senior military officers, or heads of state. Because of their status, PEPs are more vulnerable to bribery, corruption, and misuse of funds. Financial institutions must apply enhanced due diligence, ED, to PEPs, reviewing their source of wealth, connections, and ongoing transactions. Screening tools and global databases help identify PEPs and mitigate potential reputational and compliance risks. 8. How do you identify and report suspicious transactions? Suspicious transactions often involve unusual patterns such as large cash deposits, frequent international transfers, or inconsistent account activity. A KYC analyst investigates these red flags through transaction monitoring systems and customer profiling. If a transaction appears suspicious, the analyst files a Suspicious Activity Report, SAR, or Suspicious Transaction Report, STR, with the appropriate authority. Accuracy, documentation, and confidentiality are critical to ensure compliance and avoid tipping off the customer involved. 9. What systems or tools are commonly used in KYC analysis? KYC analysts rely on specialized tools for identity verification, screening, and risk monitoring. Common tools include WorldCheck, LexisNexis, Refinitiv, Acuity, Dow Jones Risk and Compliance, and internal case management software. These platforms help identify sanctions, PEPs, and adverse media mentions. Automated screening improves accuracy and reduces manual errors. Analysts must also be comfortable using Excel, databases, and CRM systems to organize client data, conduct reviews, and prepare audit-ready reports. 10. What is the difference between onboarding and periodic review? Onboarding is the initial process where customer information is collected and verified before an account is opened. Periodic review, however, happens at regular intervals to ensure the customer's data remains up to date and risk levels are accurate. Low-risk clients may be reviewed every few years, while high-risk clients are reviewed more frequently. Regular reviews ensure compliance with evolving regulations and help detect any changes in client behavior or ownership structures that could indicate risk. 11. How do sanctions lists affect KYC procedures? Sanctions lists, such as those from OFAC, UN, EU, or HMT, contain individuals or entities prohibited from financial dealings. During KYC checks, customer names are screened against these lists. If a match is found, the account is immediately flagged and escalated for investigation. Engaging with sanctioned parties can result in heavy penalties and reputational damage, so strict sanctions screening is essential to protect institutions and maintain global regulatory compliance. 12. What is the difference between onboarding for individuals and corporates? For individuals, KYC involves verifying personal identity and address documents. For corporates, the process is more complex. Analysts must verify registration certificates, beneficial ownership details, tax numbers, and business activities. It's also important to identify ultimate beneficial owners, UBOs, who control 25% or more of the entity. Analysts perform background checks on directors and shareholders to detect hidden risks. This ensures the company is legitimate and not a front for money laundering. 13. What challenges do KYC analysts face in their work? KYC analysts often face challenges like incomplete documentation, time-consuming reviews, changing regulations, and system errors. Clients may delay providing documents or submit inconsistent information. Another challenge is balancing speed with accuracy under strict deadlines. Regulatory updates also require analysts to stay informed and continuously adapt processes. Despite these challenges, attention to detail, communication skills, and teamwork are essential to maintaining compliance and operational efficiency. 14. How do you handle a potential false positive in screening? False positives occur when a customer name matches a record on a watchlist but is not the same person or entity. Analysts review supporting data such as date of birth, nationality, address, or company registration to confirm the match. If it's a false positive, documentation is maintained, and the case is closed. However, if doubt remains, it's escalated for secondary review. Proper investigation ensures compliance while avoiding unnecessary account delays or customer frustration. 15. What is an ultimate beneficial owner, UBO? A UBO is the individual who ultimately owns or controls a company, directly or indirectly, through shares, voting rights, or other means. Identifying UBOs is crucial in corporate KYC because criminals may hide behind complex ownership structures to launder money. Regulations require analysts to trace ownership to the natural person level. Verifying UBO identities, understanding their role, and assessing their risk level helps ensure transparency and prevent misuse of corporate entities for illegal activities. 16. How do regulatory frameworks differ across regions? While the core principles of KYC and AML remain global, regional regulations vary. For example, the USA follows the Bank Secrecy Act, BSA, and Patriot Act. The EU follows the 6th AML Directive, and the UK adheres to FCA and JMLSG guidelines. Asian countries may follow FATF recommendations with local adaptations. A good KYC analyst must understand the specific laws of their jurisdiction while aligning with international standards to ensure global compliance. 17. How do you ensure data privacy in KYC processes? Data privacy is critical when handling customer information. Analysts must comply with GDPR, local data protection laws, and internal confidentiality policies. Customer data should only be accessed for legitimate purposes and securely stored in encrypted systems. Sharing information with third parties must be authorized and documented. Regular audits and secure disposal of outdated data also help maintain privacy. Trust and compliance go hand in hand. Protecting data builds customer confidence and institutional integrity. 18. What red flags might indicate money laundering? Red flags include unusually large cash transactions, inconsistent business activities, rapid movement of funds between multiple accounts, or sudden changes in ownership. Other signs include reluctance to provide documentation, transactions with high-risk countries, and unusual use of third-party accounts. A good KYC analyst investigates patterns holistically. Not every large transaction is illegal. but combining multiple red flags helps identify potential money laundering behavior and triggers necessary reporting actions. 19. How do you handle confidential information? Handling confidential data is one of the most important responsibilities of a KYC analyst. Information such as identity documents, financial statements, or addresses must be stored securely and only accessed by authorized personnel. Discussing client details outside official channels is strictly prohibited. Analysts follow internal confidentiality agreements and encryption policies. Any data breach or unauthorized access must be reported immediately. Respecting confidentiality safeguards both customer trust and regulatory compliance. 20. What are transaction monitoring systems? Transaction monitoring systems track customer activities in real time to identify suspicious patterns. These systems use algorithms and predefined scenarios to flag irregularities, such as large round-figure transactions or transfers to high-risk jurisdictions. Analysts review alerts, investigate cases, and file reports when necessary. Common tools include Actimize, SASAML, and Oracle FCCM. Automated monitoring improves efficiency, reduces manual workload, and ensures early detection of money laundering risks. 21. What are some key AML laws you should know? KYC analysts should be familiar with major AML regulations such as the Bank Secrecy Act, BSA, USAPATRIOT Act, EU 6th AML Directive, FATF recommendations, and Financial Conduct Authority, FCA, guidelines. These frameworks outline procedures for customer identification, record keeping, transaction monitoring, and suspicious activity reporting. Understanding these laws ensures compliance, reduces penalties, and aligns local operations with international standards in combating financial crimes. 22. How do you stay updated on KYC and AML regulations? KYC professionals must stay current through regulatory bulletins, webinars, online compliance courses, industry news platforms like Finextra or ACAMS, and company training programs. Joining professional associations and reading FATF updates helps maintain awareness of emerging trends. Regular self-learning and attending AML conferences demonstrate commitment to compliance excellence and enhance professional credibility in a rapidly changing regulatory environment. 23. How do you prioritize tasks when managing multiple KYC files? Time management is essential. Analysts usually prioritize cases based on risk level and regulatory deadlines. High-risk or time-sensitive reviews are handled first, while low-risk clients are processed later. Using workflow tools, checklists, and escalation frameworks helps maintain consistency. Communication with team members and quality assurance checks ensure accuracy under pressure. Efficient prioritization prevents backlogs and ensures compliance deadlines are consistently met. 24. How do you handle incomplete or inconsistent customer information? When documents or data appear incomplete, analysts must reach out to the client or relationship manager for clarification. Follow-ups should be documented, and the file should remain pending until all information is received. Analysts must not make assumptions. Every gap must be verified with supporting evidence. If the client repeatedly fails to provide required details, the account may be escalated or declined based on policy. Accuracy and diligence are critical for audit readiness. 25. Why should we hire you as a KYC analyst? You can say, I bring a strong understanding of KYC, AML, and regulatory frameworks, combined with attention to detail and analytical skills. I'm proactive about identifying risks and maintaining compliance while ensuring smooth customer experience. I also stay updated on new regulations and technologies, which helps me adapt quickly. Most importantly, I believe in the integrity of financial systems and take pride in protecting organizations from financial crimes. Thanks for watching. I hope these top 25 KYC analyst interview questions and answers help you feel confident and prepared. Remember, interviewers don't just test knowledge, they look for clarity, integrity, and a strong compliance mindset. If this video helped you, hit the like button, drop a comment below, and subscribe to Interview Q&A for more expert interview guides every week. Best of luck, you've got this.